let me introduce the next session speaker, Michael. So Michael Ryan is the co-founder of Bullet Point Network, and also he was former partner at Goldman Sachs. So he's very well connected, and he'll join us very soon. And the moderator for this fireside chat will be Chen, who is a general partner at IOVC, the CEO at Shinect, which is a huge supporter of Decode, and also the board member of Decode as well. So let's welcome Michael to share the screen first for the keynote, and then Shuo will give us a fireside chat. Oh, Michael, you are muted. Okay, give me a second. Let me see, how can I? Well, sorry guys, that's a technical difficulty. Can you, hi Michael, can you speak now?
How's this?
Oh,
can you hear me well?
Great. Yeah, I can hear you now. Great, amazing.
Great. Hi, everyone. It's Mike at Bullet Point Network. Great to be part of the Decode conference here tonight. And thanks, Bob, for the introduction. Shuo and I will talk quite a bit about my background and lots of things related to that. But the quick and dirty is I was a partner at Goldman Sachs at the time of the IPO and for about 8 years afterward. Managed my own family office and still do that today. And I managed about $18 billion for Harvard University, $6 billion of direct investments and $12 billion allocation to other funds. Really and truly, I'm an analyst, lifelong analyst, striving to first learn and then analyze and then decide. And we're going to talk a lot tonight about how we might be able to improve the way we analyze and think about future value of early stage companies. That's a topic which, if you advance the slide, that fascinates me greatly. I think often about the simple question of, is there a better way to predict the future value of an early stage company? Of course, we think there is, and that's why we founded Bullet Point Network. It's a process that's built on 25 years of experience for me. And if you advance the slide, I can summarize the 25 years in just 3 words: spreadsheet, memo, meeting. I think about that because the process that we use for thinking through and whether and how much to invest in a company, and frankly, which the company at the board level continues to use when they think about charting their strategic future, really boils down to spreadsheet, memo, meeting. Smart people identify an opportunity, figure out what the key drivers are for a business, talk to the founder. Then they look into the product and they think about customers, suppliers, competitors, who's being disrupted. When they have enough information, enough knowledge, they typically compile a memo or a PowerPoint. It gives the thesis. What do they have to believe for the investment to make sense? What do the upside and downside cases look like? And there's usually a spreadsheet in there. It might be the company's projections. It might be a haircut to those projections. It might be a set of cash flows that you yourself put together to think about how big this business can become. And then there's a meeting. It's a meeting among the partners in the investment team to decide whether and how much to invest. It's a great process. I've used it myself countless times. We think, though, in today's day and age, we ought to be able to do more. We should be able to connect the knowledge that's in those memos and in the stories that we tell ourselves about these companies with the numbers. And so that's really what we are doing. Now, when I think about it, if you advance the slide, what really matters in early stage investing? Well, the good news is conventional wisdom seems pretty accurate to me. Team, TAM, differentiation. They're the most important things. How great is the founder? How big is the market opportunity? And how much better is their product or service? You have to understand that first. And if you get that right, you're on your way to making a good investment. And until you understand that, you really can't proceed or shouldn't. On the other hand, if you advance the slide and you think about how we should consider upside and downside from that investment, here it seems to us that conventional wisdom is a bit off. Yes, we evaluate the founder, the market opportunity, and the product to imagine how big that business can get. But we use revenue multiples to imagine what our exit return could be. Let's take a look at that in practice. So last month, if you advance the slide, we worked with a company, a really good fund that's got great research, great founder network, really understands their space well, does tremendous research and analysis themselves. And this is the comp sheet that they had, that they provided. Boiled down to a pretty simple thing. Can this company get to $100 million in revenue? And if so, probably be able to exit or raise at a $600 million valuation, because both the mean and the median of these 15 comps was about six times. Pretty simple, right? Well, I'd say let's be careful. Let's beware the flaw of averages. People talk a lot about the law of averages, but we're concerned about the flaw of averages. Let's go ahead and look at that comp sheet one more time. Take a careful look. Turns out that 4 of these comps are trading at 10 times or greater. But unfortunately, 4 are trading at 1 time or lower. And the spread between the highest at 20 and the lowest at 0.2 is 100x. So for these 15 exit transactions, there's a spread of 100x from the highest to the lowest. So be careful if you think just 6 times is something that we can lock into. Luckily, our client had very deep knowledge of these companies. And if you advance the slide, they knew one of them was a particularly relevant comp. It had the same characteristics. It had the same go-to-market strategy. It's a really good company to really understand and dig into. Unfortunately, that one company, that single company, had a range in its revenue multiple 2x to 16x over just a 5-year period. Now it's trading at about 14 times revenue. The average over the years has been 8 times. Stepped up, the valuation did, in 3 consecutive waves as the outlook for this business changed and improved. So what we really care about here is off to the right. If the business we're looking at really grows, if it gets to scale, where can we exit, or where can we raise in terms of valuation? If we get to a substantial revenue count, what's our multiple going to be? Unfortunately, I don't think this chart or the table we just looked at really gives us much of an answer to that. Same is true if you advance the slide, look at venture funds. The multiple of invested capital, or MOIC, for VC funds is really built on the power law. Most people know the power law says that the majority of profits come from a very small number of deals in a fund. In fact, 20% or less of the deals produce 80% or more of the cumulative total profits from the fund. 40% of the deals turn out to be zeros. Those are the power laws. And the question really is, how can you be more consistent? How can you consistently avoid 1 or 2 losers, which not only cost you money, but take up a lot of your time? The portfolio companies that don't work out don't just cost you money, they end up taking a lot of time of your team. On the other hand, even more importantly, is how can you scale into 1 or 2 more winners that will return the fund and end up making you be a top quartile fund instead of a bottom quartile one. So be careful. Many companies in the portfolio don't all return the MOIC of the fund. The outliers matter. The winners really dominate, and the losers can really hurt you if they cost you a lot of time. We just think, simply put, there must be a better way. And we think, advancing the slide to look at Bullet Point Network, we think BPN can be part of it. We have a team of fundamental analysts, people much like many of you, who have studied in good schools and worked at good funds and firms and really gotten great training in how to understand a business and how to analyze it. We also built a patented software platform, a graph database model, to quantify stories by combining what human beings do in their business analysis with our patented software. We can quantify stories in scenarios. If you advance the slide, there are a couple of domains that we are focused on. Technically, what we are doing is combining research management with scenario modeling in our software. Research management is about taking the knowledge that you have from your research and your subject matter expertise and mapping it to specific drivers in a financial model. And we do that using a logical graph, a logical graphical model. On the scenario side, we use probabilistic graphical models to connect these stories to numbers, to quantify them with cash flows. Let's advance the slide and I'll tell you in simple terms what we're doing. We're doing just three things that you can't do in the spreadsheet memo meeting world. First is we're attaching research directly to the model. And if tomorrow or next week or next month you get new information, you map it and add it so that your assumptions are always supported by the best possible information and judgments you have. It's a living, breathing model. Second, we model scenarios. We don't just pick one or a couple of cases like you might do on tabs in a spreadsheet, but we take the logical combination of all the drivers and we come up with a comprehensive set of cases for actual cash flow over the many horizons, 2 years, 5 years, 10 years into the future. We don't just model cash flow. We think about how multiples may change when you reach certain milestones and as your outlook changes. And third, armed with those two things, we can see the odds of different outcomes to really understand upside and downside before we invest. It's great to know that if revenues grow and multiples expand, this could be a good investment. It's also obvious that if multiples contract or your revenue stagnates, it's going to be a loser. The question is, what are the odds? How likely is either of those two outcomes? And that's what Bullet Point Network can help with. This is a quick peek at our software. The BPN feed is really a two-way feed. We publish all of the research and evidence that is attached to assumptions, and we publish the analysis into the feed. It can come to you directly through your Slack channel or into your email, or you can go to the feed itself. And if you're permissioned for this company, if you're on the deal team, or if the CEO or board has permission to look at the analysis, you can not only browse the evidence or drill into the analysis using Tableau and other tools, but you can comment, you can post your own views, add your own evidence, and feed the model with your knowledge. So it's a living, breathing, dynamic, two-way feed. Give you a quick look at one feature. There's many that we can go through live in the software, but this is a single issue page. So on the top, we have the issue, what percent of US grocery sales will be online? And it turns out that in the first half of 2020, it doubled from 5 to 10%. COVID and the environment of 2020 was a great opportunity for online grocers, and the penetration doubled. Looks to us like the large private companies are valuing or pricing in about a 20% online grocery penetration. Now, it could be more than that. It could be 30 or 40, or it could slow down and stagnate at about 10. And so we have added lots of evidence and lots of views from companies to market experts, and we're keeping it living and breathing because it's pretty important. The call on what the ultimate penetration of grocery sales in online form will be is a big, big driver. And it actually decelerated a bit in June compared to May, bringing into question how much of the acceleration 5 to 10 was COVID related, how much is just an acceleration of an underlying trend. It's an example of the BPN feed and a single issue. We've got thousands of issues with millions of pieces of evidence attached to them, sorted, mapped, and organized, but that's a single example. The next thing is BPN Writer. This is our modeling environment. Looks a lot like a spreadsheet, but off to the right, you see the evidence that's attached directly to certain assumptions. And here we build the scenarios. We take not a Monte Carlo simulation of random data from the past. That wouldn't be useful for early stage venture or for long-term fundamental growth investing generally. We want to take the logical combinations, the kinds of things that you talk about in your meetings, that you write about in your memos, and we want to build scenarios based on those views. And we do that in BPN Writer. This is where most of our patents live, is in our modeling environment software. Let me get back to the point of exit multiples. You know, what really drives an exit multiple? Well, in another context, James Carville said it best. It's the outlook, stupid. The outlook is what matters. The outlook for what? Well, growth, profitability, and scale. How big the company can become, how profitable it will eventually be, and how stable or how much of a moat it has around it at scale. This software screenshot is 100 logical cases at the top. Each of those blue lines is a case, and at the bottom, we have valuation, revenue multiples. The rainbow chart of colors really looks at that comp sheet, and we're exploding one of the cases out and showing you the drivers behind it on the right. Here we have the kinds of things that are always talked about in the meeting, written about in the memo: market share, CAC, LTV, the lifetime value of a customer, and the penetration into the market. We've got it arrayed by their current customers, and then some key targets that are already in discussion with them, and then a big industry giant that's out there that might be hard to land, and then everybody else in the world that they could go after. And we've modeled it and framed it that way because we want to understand what could cause this company to have a 10 or a higher multiple. And unfortunately, what could cause it to be one of those that has a lower multiple? So we can think about that and understand not just the possibility, but the likelihood, the odds of these things happening based on the logic of our memos and our meetings. What that boils down to is this slide. This is on the vertical axis, the value of the company, equity value. On the horizontal is time, from today to 5-year time horizon. The dark green line is the mean or average. Now, the good news here is this early stage company appears to have an average MOIC, or multiple of invested capital, 15.8 times. That's pretty good. But again, we want to look beyond just a simple average. We want to think about how likely is various upside cases and what does the downside look like. Here in the table at the top, you can see that we've got about a 47% chance of a 2x return. And that's about the minimum you'd want from any kind of a private, risky venture stage investment. Even more important, there's about a 1/3 chance of a 10x here. And because this is an early entry into a business with traction, some big early customers in a very large market, there's a chance of a 100x return. We think a 3% chance based on the logic of our assumptions right now. Now, on the downside, there's almost a 45% chance that you lose money on this investment. Now, we think there's some salvage value here. There's some good IP and a strong management team. So you may only have a 1 in 5 chance of losing all your money. But this investment looks pretty interesting because if you had a portfolio, a diversified portfolio of 25 or 100 of these, you'd expect returns of approximately 15x. But you have to appreciate that that's coming from a 1 in 3 chance of getting a 10x balanced against a 1 in 5 chance of losing all your money. We can think about that, and we've got a lot of evidence attached in the BPN feed to all the key assumptions. So that's really what we do at Bullet Point Network is we connect stories to scenarios, and we quantify the story in a way that you can't do just by writing memos, having meetings, and thinking about these key issues. We want to translate that into cash flows, exit multiples, and the odds of different upside and downside returns. So that's it for this quick introduction. Happy to talk with Shuo and go through your questions as well.
Amazing. Thanks so much for that introduction, Mike. I know we originally connected as fellow alumni of Goldman Sachs, and we were discussing about opportunities to work together. And so I'm really excited that we've had this opportunity to host you here at Decode and have you share more about what you're working on with everyone. So I know you've opened sharing a little bit more about your background with everyone, but I think as Bob mentioned in the introduction, given that we're a conference, actually the largest co-hosted tech and innovation conference by Berkeley and Stanford, we have a bunch of students as well as alumni. So maybe we could start talking a little bit about how you thought through the different career choices that you've made so far, especially the important landmarks and turning points, and sharing a little bit more with everyone advice that you would have for young entrepreneurs and aspiring investors.
Sure, thanks, Shuo. Well, my advice, first of all, and then I'll talk about my own path, is to find your power zone, to find the intersection between what you're great at and what you love to do. And I think if you spend most of your time just pursuing opportunities and piling opportunities in that intersection, I think you'll be both happy and successful. In my case, I grew up in Staten Island, New York, and then I went to college at Yale University. It was a very small universe for me. All my life for the first 25 years was in a 100-mile radius, and most of it was just in New York City. I didn't know a lot about anything, actually, but I didn't know a lot about finance or investing or technology or anything like the current group of students today, including the ones that we hire at Bullet Point Network. And I will say, just as a small plug, we are hiring right now. We're hiring analysts. So if anyone is really interested in fundamental analysis and wants to sort of talk to us about that, feel free. But I find that the current generation of students and recent alumni are vastly more well-informed, much more knowledgeable about what's out there and also about themselves than I was. To be very candid, I started my career by virtue of taking interviews with everybody and anybody that I could. And I talked to companies like Procter & Gamble, the big consumer brand company, like Bain and McKinsey, the consulting firms like Goldman Sachs and other investment banks. And I looked at all kinds of opportunities as a good example or illustration of just how little I knew. Out of that process, I decided that working at Goldman Sachs was the right choice for me. The people were great, and the opportunity really resonated with me to learn about finance and markets. And as I said in my own introduction, I am an analyst at the core. And so really learning how to do analysis in a first-class way was quite interesting to me. I liked it there. I learned a lot. I met great people, and I basically stayed for about 2 decades. And I got a chance to work in lots of areas. I lived in Hong Kong, in Tokyo, in London, but mostly in New York. And I worked on all kinds of fascinating transactions and ran some interesting businesses. When I left Goldman Sachs, I really managed my own family office. It was really the earnings that I had from the IPO of the firm and from my career there over 20 years. And I continue to do that today, and that's fascinating. That's really one of the things that I like most about my life and my job is thinking about how to invest my capital. Harvard University asked me to come and manage some money for the endowment. I managed there about $18 billion, $6 billion in direct investments and about $12 billion allocation to other funds. And that second part was really eye-opening to me. I got to see and experience how many great investors work and think. I really got to see their process firsthand, because when you're handing out allocations from Harvard and you have $12 billion to allocate, very easy to get meetings. People love meeting with you. They think your jokes are funny and they're happy to get you on their calendar. So I was basically able to meet with a lot of great investors and a lot of great funds, and I really learned a lot about their process and their people. I made a pretty big change from that when I started Bullet Point Network. It was a very deliberate change. Bullet Point Network is a startup company. We have a view, we have a belief, we're zealots. We think that we can do research, analysis, and modeling better than it's ever been done. And that's a big statement, because there are so many successful investors and so much great investment process that we've seen and experienced and been exposed to, that to think that you can introduce something that is groundbreaking and adds to the body of knowledge in that area is a pretty big claim. But we think we can, because we think that the ability to logically organize and map the information that you work so hard to get to the drivers of the company that you're thinking about investing to, rather than just having a long flat list of all the knowledge you had, like all the emails that fly around or all the posts into your Slack channel or all the appendices on your memo, a long flat list of all the knowledge you got. We break it down and map it into logical, graphical database. And then when we quantify it, we have the ability to look at all those scenarios. And that was a really big leap. That was an exciting thing to career-wise go and start a company and have a dozen people, not 1,000 or 5,000 working with me, and really try to change the way people can value companies and think about investments, and then how those companies themselves can sometimes use it strategically to think about their own future. So that was a pretty deliberate change and a pretty exciting one. You know, what have I learned from all that? Well, first of all, I think I've learned the importance of change and adaptation. The world changes. It's changed a lot in the last 3 decades. Opportunities change literally moment to moment, and things happen that are unexpected. I mean, I think 2020 has been a year of just unexpected activity. I mean, the health side of 2020, the economic impact of that, and the acceleration of some of the technological changes and some of the business practice changes has been breathtaking. So I don't think, if we're honest, many people in their fourth quarter of last year, thinking ahead for what they would do in this 2020, had this scenario completely mapped out. I think there's been a whole lot of unexpected things. And that's just a great reminder that things always are different than you plan. And so you have to have an open mind and a quick ability to adapt and change. And that's been a great learning experience. The other thing I'd say I learned more recently in the bullet point network era is the real critical need to prioritize. I always thought I was pretty good at prioritization. Always worked pretty hard, always seem to have a lot on my plate. But when you're running a startup company and when you're thinking about changing an industry, as we're trying to do with the work we're doing, you really have the potential to get distracted and try to do too many things. And so you have to focus on what's mission critical. And what you say no to is as important as what you say yes to. And so we really have had to learn a lot of lessons of prioritization of late.
I think your advice is perfect, given that the audience of a conference today is really focused on technology and innovation, and you've really, in terms of your career, spanned across investments to now really running a company that's in the intersection of technology as well as entrepreneurship. So this is perfect. Now, having sat on the advisory board for Decode for 5 years, I know that the organization has connected a bunch of our speakers to great aspiring entrepreneurs, as well as people who are looking for opportunities for careers. So we'd love to be helpful in connecting you to people. If anyone in the audience is interested in applying, feel free to reach out to Bob. I'm sure Bob will share his contact information, so you can reach out and we'll be happy to help connect you. And so the next question I wanted to ask is, now that you've had literally decades of experience to reflect on, when you think back, what would be some of the top lessons or things that you've learned along the way that you wish you knew 20, 30 years ago?
Yeah, that's a great question. I would say near the top of the list is the importance of relationships in 2 senses of that word as it's defined in the dictionary. The obvious sense is just people. People are the way that we come to learn most things, and it's the way that we come in contact with most of the opportunities in our lives. And so developing and cherishing relationships is something that is very, very important, and sounds pretty obvious, actually, and it's almost embarrassing to admit that that's something that I really learned and didn't just know organically when I was starting in my career. But what I would say is, with the benefit of several decades of experience and some hindsight, it's become more clear just how critical and how valuable and how important relationships are in every respect, including, incidentally, relationships with people who challenge you and tell you when you're wrong, as well as with people who bring you opportunities and create open doors for you. So that's one sense of the word relationships. The other sense, which is a little bit different, is just the relationships between variables. Compounding, frankly. Everyone knows that compound interest is a powerful force. Well, the relationship between drivers of a business is something that I really have learned, both the happy way and the hard way. What I mean is, when things go well, the confluence of factors that are conspiring and working together can accelerate in spectacularly positive fashion. And so things are related. And so, you know, as an example from a business sense, if your product is really better, if it's demonstrably better, if you're the Google of your space and you have a dominant category leadership product, lots of things are going to go well. Your cost of customer acquisition is going to be very low. The lifetime duration of your customers is going to be very long. Your need for spend on marketing is going to be fairly low. Your ability to attract talent is going to be very high. You're going to get great people into your organization. And the confluence and compounding of all those factors, because they are related, they're all related to the same thing, can make you a much bigger success than you perhaps ever dreamed of. The context that I use for that, the best context is probably Amazon. When Amazon came to people's attention in the mid-90s as a private company and in the late 90s in its IPO, it was a bookseller. It was selling books to people in a new way. And it had the potential to be the world's best bookseller for a variety of reasons. But the number of markets, first of all, in the retail space, the number of different categories that they delivered and their overall process for e-commerce was so dominant. And then, of course, they built the AWS server back-end business, which is perhaps even more valuable. And so the number of things that have happened to Amazon and the compounding nature of how those variables were related has produced a spectacular success. Now, on the other hand, relationships can also hurt you when things compound negatively. And that's something else to be humble about and reminded of. When things go wrong, they can go horribly wrong and horribly fast because things are all together compounding. And so as an example, when your product isn't working as well, not only will your cost of customer acquisition be higher and your need for R&D spend be greater, but you'll probably have a harder time attracting talent, retaining talent, motivating your team, and so things can go horribly wrong in a related negative way as well. So relationships probably the biggest thing, both the personal kind and the way that variables and things can be related and compound.
I love how you tied in-person relationships to the relationship between variables as well. And I know last time we were video chatting, you were talking about how you fly to San Francisco frequently because you really value these in-person interactions and really using that as an important part of building a relationship. So I think everyone online now is experiencing online events for some of them, you know, for the very first time. So any advice for how to connect as COVID has impacted so many people across the states and how people can continue to build relationships digitally?
Well, it's another very good question. I mean, I do value human relationships and I do visit in person. We closed our office in New York and in San Mateo, California, roughly March 5th. And so this has been a very unusual period for me where we've had, and my wife and family can attest that this has been a very unusual period where I haven't been traveling, kind of unprecedented in decades of my life. But I think the couple things that we've learned as a community, I would say, about online connectivity is, first of all, it works. We're experiencing it here tonight and you know, today, wherever you are. And I think that I will probably continue to value personal connection face-to-face, but I'm sure that I'll be confident to use video connection even more so. At BPN, we've had a long history of using Zooms and Meets to connect with people, but it's obviously become 100% of our activity today. And I think, you know, it's great to find that it can really work. It helps to be organized and purposeful. And again, that may spill over into the human kind of meeting. I think our human meetings may be a little bit more organized and purposeful, you know, in the post-COVID world, because we've all been learning and somewhat forced to do so with a little bit tighter scheduling, a little bit more clear agendas, a little bit greater focus. I think the other thing that is true about digital connectivity is it can work very, very well for collaborating and sharing, and you know, screen share is a word that's in the lexicon now for everyone. And I think the ability to literally collaborate and show work and show material, and you're talking to a company and they can not only show you what they brought to the meeting in their pitch deck, or they can just literally show you as much as they're willing to direct from their product, their R&D bench, their sales pipeline, their team management, human capital. You know, I've just frankly found that in these Zoom meetings and these online connections, people are much more prone to just opening up detail and sharing substantive things with you over the video that you probably would have gotten to in the course of the relationship and the diligence, if you will, but it might have taken you quite a bit longer. So it's been pretty efficient. The last thing I'd say, which might be interesting to some, and probably don't have time for a big debate on it here, but there's an East Coast, West Coast divide in the United States, in my experience, about work from home and video conferencing generally. In California, everybody thinks it's the future and it's going to be dominant, and maybe no one will ever go back to work again. Maybe we'll never go into the office again. In New York, no one is thinking that way. Everyone thinks that they are going back to New York to work pretty soon, or as soon as possible, and they like the environment and they like the connectivity. Now, the truth is obviously somewhere in the middle. I think we are all going to go to offices some of the time. I think we all probably will use more remote and connectivity-based meetings some of the time. But I will tell you that it's been fascinating to me to be bi-coastal and see everybody in California think work from home is forever and is great, and everybody in New York think that going back to work in an office can't happen soon enough. So we'll see what the future holds.
That is so very true. My sister lives in New York, and there's absolutely a divide between West Coast and East Coast. And I'm also acutely aware you're based on the East Coast, so it's already super late your time. So really appreciate you taking the time to join us. But that also speaks to the magic of digital connection, because I know we have hundreds of people online right now, literally located all the way across the world. I saw someone in messaging who was hailing from Indonesia. And so there's alumni all over the place, and people are all dialing in to join. So really appreciate you being here. I thought maybe we could end with one last question.
Sure.
We've discussed innovation and technologies, but as we look forward to the future, what would you say are some of the most impactful or important pieces of technologies going forward that might impact investing and finance going forward? And how can people currently with us now, our audience members, potentially think about leveraging that into exponentially growing their own personal careers as well as the companies that they're building?
Great. Well, again, I think that there's been so much advancement in technology across the many industries, but my observation, funny enough, is that the financial industry, the investing business in particular, has been relatively slow to adopt. And so one of the things that we look for in our own investments is we like to find industries that are big and important, but which have been slow to change and modernize. And then when they get the momentum, some of the sort of early activity in the direction of modernization, the benefits can be tremendous. Now, there's certainly things that have been modernized substantially in fintech and in financial services, but most of that has been around the consumer side of things, first of all, and secondly, about for using an old-fashioned terms, the back office or the efficiency side of running a financial services firm. The core activity of lending and investing has been relatively slow to embrace technology. Now, various kinds of big data and machine learning and ingestion of information and recognition of patterns have proven to be particularly helpful in some of the credit algorithms and things that people use to identify the willingness and ability of a borrower to pay back the loan. And that's something that I think is going to continue. On the equity side, if you think about venture capital, all the way to public stocks that have high growth trajectories, it's very, very difficult to use AI or use any kind of machine learned crunching of past data to predict what will happen in the long term. And I think the reason for that is, first of all, the future is very different from the past for most dynamic, disruptive, exciting growth companies. Their whole reason for being is that they're going to change something about the future. And so by definition, what's happened in the past is less relevant. They're hoping to make it less relevant with their product or service or growth strategy. By the same token, though, that doesn't mean there's not a role for technology. And I talked about it a little bit in my own presentation. I think there's been lots and lots of information availability. And so probably the biggest change in my lifetime technologically has been the abundance of information that's now accessible to us all, largely through the internet and other media. So what you can do now is you can get more information than ever before. And what I think the real next step is going to be is figuring out how to use that information better, how to filter it, how to prioritize it, how to categorize it, and how to put it into practice. And when you get down to doing that for a growth stage company, someone that's going to grow and have potentially vast uncertainty, largely because their growth rates are going to be so high and the markets they're going to go after are so vast. You really have to connect that story. You know, what does the founder believe? What does the executive team, if it's a more mature company, think? And what's the true market opportunity, and what story are they telling? And you have to ask yourself, well, what do I have to believe as an investor to buy into that story? And then get as much evidence as you can to support that. Evidence is a strong word. Most people think of data, they think of past data, but evidence can include the views of experts, can include talking to customers, suppliers, competitors. Obviously, the CEO and advisory board and board of directors around the company are experts. And I think you need to become very cognizant of marrying quantitative data with qualitative insights, and connecting those two together to form your conclusions is really key. So I think as we go forward, most of the work that's been done is around getting information. The next chapter is going to be about using it and using it better to inform your decisions. And that's something that I'm really very excited about.
And I definitely resonate with that. I personally look very much forward to working more with you as well as the rest of the team at Bullet Point Network. And I look forward to helping the audience connect more with you and BPN as well. Thank you so much again for your time, and hope you have a good night.
Thanks, Shuo. Great being with you.
Take care.
Thank you.
Thanks, Bob.
Thank you.